Thank you very much for the kind introduction, and thanks a lot for the opportunity to present today. As just mentioned, we are looking at implementing climate strategies with the perspective of the Paris Agreement. This gives us a political framework around which we can align our technical implementation. Thanks. So the Paris Agreement, I guess most people are familiar with it. In terms of the details of what it means, we're looking at a well below 2-degree target, which means we would like temperatures to increase by no more than 2 degrees by the time we become carbon neutral. So by the time we actually stop emitting more carbon into the environment than we're taking out through carbon sinks like trees and other such devices. And by that time, temperatures will increase by 2 degrees and no more if we reach the objective. This means that we want to limit the amount of carbon that is emitted. And if we were to look at what current pathway we're on, this is according to the science-based targets on the left-hand side, you will see that the current pathway is 4 to 6 degrees of temperature increase. Which means if we're continuing as business as usual, temperatures will increase by 4 to 6 degrees above what they were in pre-industrial levels. Bearing in mind that in pre-industrial eras, the humanity has not managed to emit much CO2, and nearly all of it has come since the early 1900s, as you can see on the chart. The Paris Agreement had very strong and definitive overall targets. So the aim of having a well below 2-degree increase is scientifically quantifiable. And for that, we have a carbon budget calculated by the IPCC. But every country was left individually to determine what their own targets would be. And these are called the nationally determined contributions. And if you sum up all of the the NDCs, you get to a number that is much larger than the allowed budget overall, which means that if every country does what they say they will do, there is no chance that we'll achieve the Paris Agreement targets. This is why probably the private sector needs to play its part, as well as governments need to, let's say, enhance their commitments. And also research has shown from the IPCC that 2 degrees is probably not going to be sufficient in terms of aggressivity of our climate strategy, because there will be significant impact on the environment that will be non-reversible. It will be tipping points to the point of no return, that if actually we increase temperatures by more than 1.5 degrees, we will still have significant problems that will be generated through climate change. For example, the Arctic ice has melted by over 40% since 1970. The more this melts, the less area it covers, which means the faster the oceans absorb heat from the sun, and which generates more heat. And more heat generates more melting, which generates even more heat. Similarly, we have permafrost soils, so areas of land which are permanently frozen, which hold about 1,300 to 1,600 gigatons of CO2 equivalents. If this ice melts, all of this will be released in the environment, which of course leads to more heating, which leads to more melting, which leads to more heating. So the vicious circle will be is already being unleashed, but it will be an exponential problem and much harder to deal with the later we leave it and the higher the temperatures rise. And the IPCC set a target of 1.5 degrees, after which we basically reach the point of no return in terms of significant climate change and and accelerating natural disasters and all of the other consequences that come with it. So as was mentioned in the introduction, we're looking at a 50% reduction for the 1.5 degree target by 2030 and a 30% reduction for 2 degrees, which essentially means 4% per annum of reduction for 2-degree scenario and 7.5% reduction per year for a 1.5-degree scenario. What does this mean in practice towards all the way to 2050? So carbon neutral does not mean that we no longer emit carbon or equivalents. It means that whatever is emitted is actually also being taken out of the environment. So there's no plan to fully stop the emission of carbon at all. But the plan will be that by 2050, all of carbon emissions will be taken into carbon sinks. And by 2100, there will be no more net emissions of greenhouse gases altogether. So by following the Paris Agreement and trying to keep temperatures below 2 degrees or 1.5 degrees, we have a carbon budget which needs to not be breached. And so it means that emissions, net emissions, need to be below something that looks like this green line on the chart. And for a 2-degree scenario, this means a 70% reduction of greenhouse gases by 2050. This actually matches the 4% per annum annual reduction. So the integral of the area of the whatever is under the green line is the budget that is left to not breach the target. Current temperatures, so we're talking about 1.5 degree or 2 degree as a max. We're actually already at 1.1 to 1.3 degrees above pre-industrial levels. So if you're looking at it from the perspective of percentages, we're actually extremely close to already have breached the 1.5 degrees. This is, of course, in addition to the fact that we have these point of no return events, whereas the more we have warming, the more warming there will be because of the natural consequences. We're polluting by about 51 gigatons per year, or at least we were in 2018. We're actually doing more now. The trend is not 4% reduction, but 1.25% increase per annum. The IPCC calculated budgets for 2 degree is just over 1,000 tons. Since we're emitting 51 per year, this gives us about 20 years. For 1.5 degrees, it's significantly smaller. And of course, at the current pace will be done in less than 10 years. So it's obviously something to be reckoned with and ponder what are going to be the consequences of the world that we live in. And we need to act quickly and act in a very effective manner. So how do we act? There are different approaches, of course, and a lot of the focus, at least in the developed world, where we have a lot more awareness and probably a lot more means to combat these problems, has been actually fought at home. And so even locally here in Germany, you've seen that the opening of new coal factories has been highly controversial. And there are, let's say, significant political efforts made to limit the pollution that we are generating at home. The problem is that in the overall scale, it's not enough. The problem is a global one, it's not a local one. The pollution happens, of course, at home, but pollution that happens abroad affects us just as much. And to stop us from creating a few factories in Germany or even anywhere else in the developed world, it has no impact if 368 coal factories are being planned currently in China, for example. So already coal, just to be clear, is the dirtiest form of energy. With all fossil fuels, they account for about 65% of current emissions. So bearing in mind that by 2050, we need to reduce by 70%, fossil fuel is clearly the area where we need to reduce. And coal is the dirtiest of all the fossil fuels. And actually, right now, we're not reducing our coal consumption at all, but increasing it. The current plans of global coal-emitting electricity factories stands nearly at 1,400 factories. If they were in operation today, they would increase our pollution by over 1 gigaton, which is an increase of 2% relative to current levels. So that's 2% going against the 4% reduction that we need. A key point is 40% of the financing of these factories abroad are coming from countries that are, let's say, Annex 1 in the UNFCCC. So these are the countries that have a responsibility. There are, let's say, wealthier countries that are more developed, that have caused more pollution in the past, and that have a responsibility to help the emerging markets to get cleaner. Yet we are financing a huge part of the pollution abroad, and it doesn't really help to prevent pollution at home if we're then sending money abroad to create pollution there. So financing of companies that essentially then indirectly finance pollution abroad, or financing of countries which directly finance pollution, both need to be a part of a strategy that look at sovereign investments and corporate investments alike. And that is just as important, if not more, than equity holding in terms of the accountability of the pollution. So we've mentioned China, and I'm picking China because it's the most flagrant example, but it is not the only country where we see the issue I'm about to point out. So developed markets in the last 10 years actually do have a reduction in pollution, which is about less than 1%. Clearly, we're not at 4%, let alone 7.5%, and we're very far from that. Emerging markets have an increase of 2.3%, and the red line and the green line are actually cumulative. So the total pollution in the world is the sum of the two. And so the reduction in emerging markets is less in percentage and less in amounts than the increase in emerging markets, which means if you put the two together, we're obviously increasing pollution significantly every year. And this means that we're totally off in terms of the 4% or the 7.5%. China, which is not cumulative to the red line, this dotted gray line, in the last 10 years has had a 3.2% annual increase. And is it fair to blame China? Probably not. What's happening is that they are the emerging markets have increasingly taken up the production of developed markets, and so developed markets are basically outsourcing their pollution. We are consuming about, at least in Switzerland, about 9 to 10 times more than the consumption per capita required for a 2-degree alignment. And this consumption, of course, is creating pollution, but the pollution is not being accounted for at home. It's being polluted. It's being created in foreign countries like China, where the manufacturing happens. If you look at China, it represents 28% of all industrial output in the world, which actually nearly corresponds more or less to the greenhouse gas emissions of the country versus the rest of the world, 27%. But domestic consumption in China is about 13% of the global economy, which means they produce double what they consume. So all of the other, the 28 minus 13% is being consumed abroad, and we are essentially outsourcing our pollution to those countries. So the climate crisis is a global problem, not only in the fact that carbon affects everyone, everywhere, but also because it requires a solution in the global way that we function as a society. So Swisscanto is an asset manager, and of course our aim is not only to prevent climate change. Actually, our main fiduciary responsibility is to generate return for our investors. And so the question always comes as to how can we justify having a climate strategy when our aim should be to generate return and not necessarily to help the world, quote unquote. Well, we have made a decision internally that it is our responsibility to support society wherever we can, especially if it does not come at the cost of our investors. We have the consensus internally that ESG criteria and climate especially are material to financial performance, and that they are material across all asset classes, and both corporate and sovereign. So the way that we look at a climate strategy is that we want to prevent certain risks and we want to optimize our exposure to certain opportunities. And what does that mean in essence? Well, out of climate, there are transition risks. So as we transition from a polluting economy to a carbon economy, we will see significant disruption in businesses and industries. There will be asset depreciation. There will be stranded assets. So if you're a fossil fuel company and you haven't consumed all of your fossil fuel by the time the fossil fuel is no longer in use, this is a huge part of your balance sheet that essentially is worthless. We want to limit our exposure to potential stranded assets. We want to limit our exposure to companies that provide a service which will no longer be in demand, or that use business practices that will no longer be allowed or that will be taxed heavily. And a key part of this is not only regulation, it's also client demand. We're seeing that consumers are choosing a more sustainable solution when they have the choice. Often they're even willing to pay a premium for it. An example is, for example, in Switzerland, there was a national strategy that was voted by the public whereby our energy will be all renewable by 2050. This came with the knowledge that it would increase household electricity bills significantly, but the public still voted in favor for it. So it's not state demanded. It's not that the state was forced to do such a thing because they had signed and ratified the Paris Agreement. This is something that's driven by the consumer as well. And we're seeing this as well in consumption of even small items. People are ready to pay more for organic products in the supermarket. So of course there's the health concern, but the climate concern is also a health concern indirectly. Then there's the physical risk. So if a company operates with, let's say, factories in a flood-prone area, and you have more flooding because the Arctic is melting, this obviously has a direct impact. So this is something that we need to be careful in terms of allocation. So we need to estimate the physical risk. Of course, insurance companies are highly affected by this, and they also have often very sophisticated models to deal with it. But it's not all about risk. And so there's also significant opportunity. As I mentioned before, clients are ready to pay more for a sustainable solution, which actually means there is definitely upside by providing something more sustainable. On top of that, as a race, we will have no choice but to reduce our pollution, and therefore any state or any company that provides a more sustainable solution is likely to find demand for something that enables us to reduce the pollution or do something more effectively so that we don't have to create pollution at all. It's estimated that there's about $23 trillion in emerging markets as an economic opportunity by 2030. This is a huge number, and of course will be not only capitalized by emerging markets, but also companies and states that invest abroad. And this is only to highlight what the opportunity is in the emerging markets, whereas obviously it's much larger on a global scale. So how do we essentially do this? We have a global voting and engagement approach, which encompasses all of our assets, including passive assets, where we essentially just replicate an index due to client demand. We demand that companies that we invest in follow something like science-based target or some sort of scientific norm, so that we can account for the reduction in pollution and their strategy that is compliant with a 2-degree or even 1.5 degree, depending on the case, this strategy. We want there to be board level responsibility. So it's not okay to have an ESG person sitting in the corner that everyone ignores. We want there to be top level responsibility, that action is taken and that KPIs are tracked. And we also want it to be a positive for the management. So we want management to have a motivation and actually a carrot. So something to strive towards, and actually that this can help them achieve their KPIs by being more sustainable, as opposed to just being a stick and a method of punishment. We estimate that markets will reduce their pollution overall. There will be a decreasing amount of we will strive towards a 2-degree scenario. It's not sure whether we will reach it, especially as we're currently not in line, and the longer we wait, the harder it will be. But what we have done as an asset manager is we have estimated how much carbon is left in we are allowed to emit until 2050. So this was this carbon budget from IPCC. We have this 4% annual reduction, and we have fixed all of our active portfolios to be aligned with the 2-degree scenario, which means the greenhouse gas emission as measured by carbon intensity will reduce by 4% per year for all Swisscanto active funds. And this means that if all asset managers were doing exactly what we were doing, it would be pretty straightforward to achieve the 2-degree scenario. Of course, it would have consequences of certain businesses getting defunded and other businesses finding funding where in more capacity than they are currently finding, which essentially means that polluting businesses will have a much higher cost of capital. And so it will become harder for them to operate. And businesses that have sustainable solutions will have a lower cost of capital, which means they can take on more projects because their hurdle rate is lower. We have also signed this year the Net Zero Asset Manager Initiative, which binds us to have a strategy to align at some point to the 1.5-degree scenario. And so some of our funds are already aligned with the 1.5-degree scenario, and we are looking to move more and more assets towards that. But of course, we also don't want climate to be the sole driver of asset allocation. And so we're cautious in proceeding before we commit to something that will bind us for the next 30 years. And that's why all of our active funds are currently aligned with 2 degrees, and we're shifting them progressively towards the 1.5-degree scenario. We have a capital allocation lever as well. Of course, it's not just voting and engagement. So the footprint of our portfolios is driven by allocation. And so if a company does not align itself with a suitable scenario, then we will reduce and eventually divest from the company. If voting and engagement does not work, we also see capital allocation as a lever for pressure. And we also exclude certain companies that are not compatible with our view of the future. So for example, companies that operate in thermal coal to a significant extent will not make it into any of our portfolios, our active portfolios. And so also UNPRI breaches and so on. And so there are certain standards that need to be met for us to invest at all. And then, of course, there's the amount which can be invested based on the footprint that this would result in. What's important in a climate strategy is to not just focus on carbon. So carbon is, of course, a great piece of data, but it's actually historical. And so we don't want to base everything on past data. We have a multifaceted approach, which takes into account multiple dimensions. So we look at controversies which have a lot more than what is shown, but here we highlight the environmental KPIs that are relevant. There are many KPIs on the controversy score. So, you know, how does a company operate with respect to, well, does it respect the environment? Does it do what it can to mitigate pollution when it's cost effective to do so? We have an ESG score where, of course, E in the ESG is environment. So there we're really looking at the forward-looking strategy. Does the company have a strategy at all? And we find that that is definitely not always the case. And we ask management of companies this question often. And CFOs sometimes tell us that there is no strategy, which of course means that either there needs to be a strategy or we will be leaving the investment pretty soon. We look at impact along the lines of the SDGs. Obviously, some of them are climate related as well, but they are also all interrelated. And then, of course, there's the carbon itself, which is the key measurement in terms of being able to measure, at least in the past, what has happened. So with that, I think we have a few minutes for questions.
Questions in the room? Very, very, very interesting and very good presentation. I have a question with respect to the escalation procedure. So you told us about the process, the voting and engagement, and then you jump to exclusion. For me, the escalation is going a little bit further. Do you consider, for instance, litigation? I'm quoting Alex Edman from London School of Economics, who says, when you exit, you basically do not change anything. You do not improve the situation. You just leave the company alone and they can continue to do whatever they want. So are you having another escalation procedure in place?
So we are part of multiple initiatives such as Climate Aware 100 Plus, UNPRI, and many grouped efforts as well with ISS and Sustainalytics, where we're supported. And so there is anyway impact in the fact that whether we're invested or not, because we represent a certain sum of money, which helps these initiatives go forward. So if you're not invested, the company still sees that as a potential investment, which may get them to improve so that they can get that potential investment. To the point that we don't change anything, that's not actually, I would say it's not entirely correct. Of course, if you take out, let's say, a $10 million investment out of a $1 trillion company, it doesn't have a lot of impact, but it does have some impact in terms of reducing demand for the stock. And if many investors do the same, that impact will be even larger. And so every dollar actually does have a little bit of an impact in terms of share price. It's even more pronounced on debt issues. So if you simply do not bid for a bond, the yield on the bond will be higher, which means the company pays more. And if the company has a higher cost of capital, it essentially means that it will take on less projects and pollute less, and may also at some point even go out of business altogether.
Thanks, Ruben. Was there a second question in the room?
Yes, regarding the portfolio, if you change right now from 2 degrees to the 1.5 degrees target, how much would it shrink your portfolio right now? I mean, companies will improve over time, but said today, have you a guess how much the companies, investable companies, or which is your portfolio in total right now would shrink?
So we don't only hold companies that are aligned with the scenario, with the given scenario. And this is where we have to look at it from a multifaceted perspective. We can invest in a company that is not necessarily aligned with a 2-degree scenario, but then it means that the portfolio manager has to compensate the pollution of that company by reducing even further in other parts of the portfolio. And so I couldn't really give you a clear-cut answer in terms of what gets removed. The difference between the two scenarios is that we're looking at a 4% annual reduction for 2 degrees and a 7.5% reduction for 1.5. And so it means that the carbon footprint of the portfolio will decrease much faster in the 1.5 degree.
Thank you very much, Ruben. That was really much appreciated, and you see the questions are going really into details. So I think you are directly from the horse's mouth to the investors. So that's really appreciated. Thank you very much.
Thank you very much.